So, we're diving into a topic that's often misunderstood: debt. While it's easy for you to view debt as a burden, it's important to recognize that when used wisely, debt can be a powerful tool for financial growth and opportunity and can change your life. Yes, US consumer debt is nearly $17 trillion, with the average household debt exceeding $145,000. The US GDP is just over $25 trillion, making it seem like the entire economy runs on debt. But here's the good news: not all debt is bad. Many of us have credit card debt, car loans, and student loans, which can feel overwhelming. However, understanding how wealthy people use debt can change your perspective. Debt, when used wisely, can be a powerful tool to generate more wealth. Let's explore how rich people make money with debt, and after that, how normal people like you and me can make money with debt. First, business financing. Using debt to start a business is often seen as risky, but for traditional businesses, it can be the best option. And second, in real estate. Real estate investors often use borrowed funds, known as leverage, to purchase properties. By taking out a mortgage, an investor can buy a property with a smaller amount of their own money. The rental income from tenants is used to pay the mortgage, and any excess is profit. Third are hedge funds and short selling. Hedge funds often use debt to make money when companies fall. For example, if you expect Facebook stock to drop due to a new privacy policy from Apple, you can borrow Facebook stock and sell it at its current price. And last, Forex trading. Forex, the market where currencies are traded, also uses debt to amplify profits. For every dollar you trade, you can borrow up to $100. This leverage means even a small profit can become substantial. Predicting currency movements based on economic factors can yield significant returns. But how can you make money with debt? There are multiple ways. Arbitrage. Debt arbitrage involves borrowing money at a low interest rate and investing it in opportunities that yield a higher return. Imagine an investor named Jane who notices an opportunity in the financial markets. Jane can borrow money at a low interest rate of 2% per year because she has an excellent credit score. At the same time, she finds a stable, high-yield savings account or certificate of deposit (CD) that offers a 4% annual return. 1. Borrowing funds. Jane takes out a loan of $50,000 at a 2% annual interest rate from her bank. 2. Investing borrowed funds. Jane deposits the $50,000 into a high-yield savings account that offers a 4% annual return. 3. Earning returns. After 1 year, the high-yield savings account generates a return of 4%, which amounts to $2,000. 4. Paying interest. Jane needs to pay the interest on her loan, which at 2% amounts to $1,000 for the year. 5. Calculating profit. Jane's net profit is the difference between the return on the savings account and the cost of the loan interest. Return from savings account: $2,000. Interest on loan: $1,000. Net profit: $2,000 minus $1,000, that's $1,000 in profit. Through debt arbitrage, Jane has earned a net profit of $1,000 by borrowing at a low interest rate and investing in a higher-yielding, low-risk asset. This example assumes the high-yield savings account is FDIC insured, making it a very low-risk investment. Next is dropshipping. Dropshipping is a retail fulfillment method where an online store doesn't keep the products it sells in stock. Instead, when a store sells a product, it purchases the item from a third party, a supplier, and has it shipped directly to the customer. Here's how you can make money with dropshipping. Jane wants to start a dropshipping business focused on eco-friendly products. She plans to use a $5,000 loan to cover initial expenses. 1. Securing a loan. Jane takes out a $5,000 loan at an annual interest rate of 5%. 2. Setting up the business. E-commerce platform. Jane spends $500 on setting up a Shopify store. Marketing. She allocates $3,000 to social media ads, Google Ads, and influencer marketing. Software and tools. Jane spends $300 on inventory management and dropshipping software like Oberlo. Miscellaneous expenses. She reserves $500 for website design and other costs. After finding suppliers, listing products, and handling all the process, the calculating profit will be: after a month, Jane sells 500 reusable bags. Revenue: 500 bags into $20 equals $10,000. Cost of goods sold: 500 bags into $10 equals $5,000. Gross profit will be $10,000 minus $5,000 equals $5,000. Loan interest, $5,000, 5% equals $250 annually. Net profit, monthly $5,000 minus $250 divided by 12 is almost equal to $4,979. By effectively managing her dropshipping business, Jane makes a substantial profit while using debt to finance her initial setup costs. And now how people like us can make money with debt using real estate. Let's take the example of John. John wants to invest in real estate and decides to purchase a rental property using a mortgage. 1. Securing financing. John obtains a mortgage for $200,000 with an interest rate of 4% and a 20-year term. He makes a 20% down payment of $50,000, making the total property cost $250,000. 2. Choosing the property. John finds a duplex in a high-demand rental area. The property is priced at $250,000 and requires $10,000 in minor renovations. 3. Calculating costs and returns. Down payment, $50,000. Loan amount, $200,000. Monthly mortgage payment, approximately $1,200, including principal and interest. Renovation costs, $10,000. Total initial investment, $60,000, down payment plus renovation costs. Potential rental income, $1,500 per unit per month. Since it's a duplex, total rental income is $3,000 per month. 4. Purchasing the property. John buys the duplex and completes the $10,000 renovations, making the property more attractive to tenants. 5. Renting the property. John rents out both units for $1,500 each, generating $3,000 in monthly rental income.
Si managing finance.
Monthly rental income, $3,000. Monthly mortgage payment, $1,200. Other monthly expenses, taxes, insurance, maintenance, $500. Net monthly income, $3,000 minus $1,700 equals $1,300 in profit. Debt can be a powerful tool when used wisely. It's essential to differentiate between bad debt, like high-interest credit card debt, and good debt that can generate income and build wealth. By understanding and utilizing debt strategically, you can turn it into an ally rather than an adversary. If you enjoyed this video, please give it a thumbs up. If you're new here, subscribe and turn on notifications to learn more about money, investing, and more. Thanks for watching, and I'll see you in the next one.